Today, I will be presenting you with a strategic evaluation of our paid search campaigns performance with one singular goal in mind: to determine how we can improve return on ad spend while maintaining scalable revenue growth. At the moment, paid search is functioning as a strong growth engine for the business. Revenue has demonstrated the ability to scale when supported by increased investment, and the channel is clearly contributing to meaningful top line impact. However, growth alone does not guarantee efficiency. As leadership, the key question is not simply whether revenue is increasing, rather, it's whether that revenue is being generated as effectively and efficiently as possible. In other words, are we deploying the capital in segments that produce the strongest marginal return per dollar spent? Paid search provides us with this answer and gives us the flexibility to allocate our budget dynamically. That flexibility creates opportunity, but it also requires disciplined decision making. This analysis at hand evaluates revenue trend, traffic expansion, campaign concentration, and conversion efficiency in order to identify where budget reallocation can improve both growth and profitability. The objective is not just to scale, but to scale intelligently, aligning spend with performance drivers that maximize capital productivity. With that in mind, I'll begin overall revenue performance. As we look at cost versus revenue over time, there is a clear and direct relationship between increased ad spend and increased ad revenue. Following a dip between August and September, both spend and revenue rebounded sharply in November. In fact, revenue increased by nearly 200,000 month over month during this period, as we can see during the significantly scaling arrow on the cost versus revenue over time graph. This strategically is significant for two reasons. First, it confirms that paid search is highly responsive to incremental budget during peak demand periods. When we increase investment, the channel delivers proportional top line impact. This responsiveness indicates elasticity, which means that the channel has not reached diminishing marginal returns at its current funding levels. The channel is not saturated. It is scalable when we fund it appropriately. Second, it demonstrates that the campaign has structural ability to absorb increased spend without eroding performance efficiently in the short term. We did not see revenue plateau as spend increased. Instead, we saw acceleration. From a leadership standpoint, this validates paid search as scalable growth lever, which is exactly what we want to see in the performance channel. However, it's important to note and distinguish between scaling revenue and optimizing return. Increasing spend can grow revenue, but that does not automatically attribute and mean that we are maximizing capital productivity. The more important strategic question is whether we are scaling efficiently or are we just simply scaling by volume. To answer that, we need to understand specifically what drove that November growth and how the traffic campaign behaved across the segments. Examining impressions and clicks over time, we can see that November revenue growth was driven primarily by traffic expansion. Impressions increased by over 800,000 in November, and click volume mirrored that growth pattern. This confirms that increased spend translated directly into increased visibility and traffic acquisition. When we funded the channel more aggressively, we captured significantly more search demand. The campaign did not struggle to find inventory, it scaled reach. From a demand capture perspective, this is a strong performance. It indicates that the market demand exists and that our paid search structure is capable of servicing ads effectively when budget constraints are loosened. However, traffic growth does not just equal profit growth. High volume campaigns can accelerate revenue, but they do not always represent the highest return per dollar invested. This is important. Increased impressions and clicks improve top line performance, but they can also mask inefficiencies if conversion quality varies across segments. For leadership, the key distinction is this: are we simply buying more traffic or are we buying higher value traffic? Because sustainable growth requires not just volume expansion, but capital efficiency. So the strategic question now becomes, where is this traffic converted? And how efficiently is it converting once it arrives? Well, let's tackle this question directly. When breaking performance down by ad group, we see that click volume is heavily concentrated within one-of-one mobile campaigns. The top three mobile ad groups drive the majority of the clicks. Most notably, the Shop Coupon group generated over 100,000 more clicks than any other campaign. This level of concentration creates both opportunity and exposure for the business. On one hand, it demonstrates that mobile campaigns are strong demand drivers and can absorb meaningful incremental budget. From a scaling perspective, this is a positive. It tells us where the traffic lives. From a portfolio management standpoint, this concentration also introduces a dependency risk. When a disproportionate share of traffic is driven by a small number of segments, overall performance becomes increasingly sensitive to fluctuations in those campaigns. If competition increases, CPCs rise, or if conversion behavior shifts, the impact on total revenue could be immediate and material. So while concentration indicates strength, it also increases volatility exposure. But this is more importantly high click volume alone because it does not determine optimal capital allocation. Traffic volume is actually the growth indicator, not a profitability indicator. The more relevant metric for budget decisions is conversion efficiency, because that determines how effectively each click translates into revenue. So the critical next step is not just identifying where traffic is concentrated, but evaluating how efficiently those segments convert once they capture that traffic. And this is exactly where the strategic leverage becomes clear. Promo code campaigns achieved a 39% conversion rate, compared to a 21% for coupon campaigns. While coupon campaigns do drive substantial traffic volume, as we can see by the graph chart, promo campaigns convert twice as much efficiently. That gap is material. It represents a structural difference in performance, not just a marginal lift. This shows promo campaigns can generate significantly more conversions per dollar of traffic acquisition, which presents us with a clear opportunity for optimization moving forward. If we continue funding high volume coupon campaigns, we are scaling revenue, but not necessarily maximizing return per dollar spent. So let's reallocate even a modest portion of budget towards high performing promo code campaigns. This would improve overall conversion output without increasing total spend. But let's take a second to justify this conservatively. If 10% of coupon campaign spend were redirected to promo campaigns, and the promo campaigns maintain a 39% conversion rate, we would expect incremental conversions at a higher rate than current average performance. Given that November's scaling alone drove nearly $200,000 in revenue, even a 5 to 8% lift in overall conversion efficiency from reallocation could translate into tens of thousands of additional revenue without requiring us to increase any additional budget. In simpler words, we have already proven the channel can scale. Now the opportunity is to improve capital productivity within that scaling. After hearing all that information, you might be thinking, where do we move forward based on these findings? Well, I want to recommend 3 strategic actions that I think would work smooth. First, we must prioritize budget allocation towards high converting mobile promo code campaigns. These segments represent the strongest incremental growth lever within the current structure, and they deliver superior efficiency per dollar invested. Reallocating budget here increases the output without increasing the total spend. Secondly, gradually decrease the spend in lower efficiency ad groups, such as desktop and long tail segments, where conversion performance declines meaningfully beyond the top campaigns. I'm not talking about eliminating them entirely. I'm just talking about tightening allocation discipline and ensuring each dollar is working to its maximum productivity. Third, continue leveraging seasonal scaling strategies during peak demand periods. November is a great example of this. It clearly demonstrated revenue responsiveness to the increased investment. The opportunity now is to pair that scaling with capability and smarter allocation. So when we scale efficiently. By combining seasonal scaling with efficiently focused reallocation, we are now able to maximize both growth and profitability. Conservatively, even a mid-single digit improvement in overall conversion efficiency layered onto the November level scale could translate into tens of thousands in incremental revenue per month. And this would allow us to not increase the total marketing budget. That is what we call capital productivity. This strategy improves return on ad spend, increases marketing contribution margin, and reduces dependency risk by aligning capital with the strongest performing signals. Ultimately, this positions paid search as not just a growth channel, but as a disciplined investment engine. The growth, it's already proven. Now the opportunity is precision, allocating capital where performance justifies it, and scaling with intent rather than volume. I appreciate your time. You have a good one. Thank you.